So as we kind of start to take a look at here is, the number one question we hear a lot is, why do I buy a home, right? And the most common call I get from a lot of, especially first-time home buyers is that, we're just tired of paying rent, right? I'm tired of throwing all that money away and not getting anything for it. Especially when you start to think about if rent's $1,000 a month, for example, $12,000 a year, that's going to somebody else to make a mortgage payment theoretically, or just going to them, where at least if you buy a house, you're able to start doing that. So, one of the greatest ways, in my opinion, to build and grow wealth is by buying a home, because a home really just becomes a forced savings account when you think about it. Every month you make that payment, a portion goes to interest, the rest goes to principal. And so that's always a nice little thing that, it's forced, you're forcing yourself to put money aside, whether you like it or not. It's kind of like if you put money in your 401k. If you don't see it leave, you don't really miss it. Same idea here. As you put that money away, the idea would be is obviously you live in an area where the house appreciates. And when you sell that home down the road, you'll have equity from it that you could either go use to buy another home or whatnot at that point. So, and of course, there's always some great tax benefits if you take a look at that approach. And then normally you have the ability to control the value of your home somewhat as far as what condition you keep that house in, right? As long as you upgrade it, you keep it, somewhat current, it's going to be worth a lot. A lot of times we see when grandma or grandpa's, home is sold, it may not be as worth as much potentially just because they haven't updated in 30 or 40 years. So, that's always something to consider on that end. So the biggest question I get all the time is, how much house can I buy? And that question has always made me a little uneasy. I don't like, and normally this is the way I do work with every client. I normally ask the question back of, well, what's in your budget on a monthly payment? And the reason for that being is my own personal story. When I bought my first house, of course, before the crash hit, so perfect timing, of course. I bought at the highest I could, and that was just one of those, if I could have waited a year, I could have got so much more, basically. But when I bought my house, they told me I think I could buy back in 2008, like 250,000. Well, when I looked at that, I started doing the math in my head because I've always been a numbers nerd. I'm like, well, that doesn't make any sense. And I was starting to hyperventilate just thinking about that payment. And then, of course, I kind of approached it a little bit differently. Like, well, I want my payment to be around X. So I think we ended up buying roughly around 170,000 at that time, which that payment fit. And that allowed us still to have a life, right? You still go out and do things and everything else. And so the question I always ask the clients, that's why I ask, what do you want your payment to be? Because the last thing I want to do is make you house poor, right? I'm not here to have, you may be able to afford, I'll use afford in air quotes, a $2,000 a month mortgage payment. However, your rent currently is about $1,000, and you may tell me, $1,200 I'm comfortable with. Great, I'm going to keep you right there. I'm not going to max you out on your budget, and most good lenders will not do that as well. And so as you approach that question, as far as how much can you afford, look at your budget, see what you can afford as far as that monthly payment goes. Most people try to stay around what their rent is currently, or have that in-depth conversation with the loan officer to say, well, I really want to be around this payment. What kind of house can that get me? Because we have a variety of factors that can affect that financing. And the biggest thing is that debt to income ratio. And we'll talk more about this as we get into the credit piece as well. That's a couple of slides down here. But debt to income essentially is all your debts to your income and what percentage is that. And there's certain, depending on the loan program, there's different percentages as far as how much debt you can have in order to afford a home. And so that's a big indication we look at. Of course, assets is always huge. The credit is one of the biggest pieces. That's normally our entry level into even having the conversation sometimes, depending on what your credit score is. So with that being said, we get to dive into the fun subject of credit scores. It is essentially the eighth wonder of the world, because there's really no good way. And for whatever reason, the three big bureaus, which is Experian, Equifax, and TransUnion, give us ideas on how credit score is scored, but they don't really divulge how it works because they don't want people manipulating it. However, we have tools out there to try to raise your score. So in effect, we are trying our own way to manipulate and bring your score up. So it's always kind of that, oxymoron, and more or less. But when we look at different credit scores, you can see on the far side of the screen there, your excellent is basically anything 800 above. I typically tell people in the world of mortgages, you get the best rates at 740 and above typically. And then anything over 760, if you're dealing with mortgage insurance, you're going to get the best rates on that end of it. But that doesn't mean if you're not in the mid to high sevens that you should just give up and quit, not even buy a house. Really, every company has different guidelines as far as what the lowest credit score can be. As of this date, right now, our lowest credit score can be about 600. Pre-COVID, we were down to 580. But our minimum right now for all loan programs is 600. And you'll find whatever lender you decide to work with will have a straight minimum, because that way, that's our way of being fair and making sure we're treating everybody equal. But even if you're between that 600 to 700 score range, there's still many different loan options that you can have accessibility to that will fit your budget and fit your lifestyle as far as what you're looking for. So don't be that if you have just a 650 credit score, for example, like, I need to really get that up. Well, maybe, talk to a loan officer, take a look at it and see what options you have at that type of a credit score. So going on here, how credit scores are broken down. So big thing is payment history. I often joke around when somebody applies and we look at their credit score and they have a 500 credit score. I joke around like you don't get to a 500 by accident. You've had to not pay things, or you've had to have maybe collections hit your account or anything. There's stuff such as that. Sometimes it's just crummy luck as far as you had a hospital stay and this, that. We understand things snowball. Unfortunately, we can only go off what the credit score tells us. They don't really give us a whole lot of the latitude. The nice thing is as you're looking at your own credit situation, medical collections don't stop you from buying a house. They can impact your score. So the biggest things you can do to control this is try to keep your payments on time. Don't pay late. Set up auto pay when possible, on accounts as far as your credit cards or auto loans, or even if you have a mortgage loan now, auto pay is great because you can never miss the payment at that point. The other big category that is looked at a lot is the amount owed. We also call it revolving utilization. Essentially what that means is what your total limit is to what your balance is. And so typically the rule of thumb is trying to keep around 30% or less. So let's just say if you have a credit card with $1,000 limit on it, trying to keep that balance $300 or less will typically help that credit score work out. A lot of times when I see somebody with a lower credit score and I take a look at it, I can run credit simulations on you and I'll tell them, hey, look, if we can pay this credit card down to this amount, it may jump your score by 30 to 40 points. So it can have a significant impact on that aspect of it. And then of course, new credit and just different stuff. But I would say the biggest thing that we see, and obviously on the chart here, it shows it's about 65% of it, is just the payment history and the amount owed. And those are stuff you can control on your end of it. But of course, always monitor your credit. You can get a free credit report a year, annualcreditreport.com. It's important to note that you'll get your credit report, but if you want the score, they'll charge you extra. And frankly, scoring is different for how mortgages credit reports done than when you pull it as a consumer with Credit Karma or CreditWise through Capital One or Discover Card. No scores are equal across the board. So if one tells you you're at a 700, I could pull your report and it may be 680. So it's just, there's a variety of differences. And once again, they weight scores differently based upon what you're going to buy. So that's a whole nother discussion for another day. Another big thing that I've been running into is don't co-sign for other people, because most of the time you're really not co-signing. You're actually the co-applicant, which means that you're fully responsible for that debt regardless. And you may be helping out your son, daughter, friend, brother, sister, whoever. You're helping them out, but a client I just talked with yesterday, she has 3 car loans that she is co-signed for. She thought she was co-signed. She's co-applicant. She can't buy a house. I can't do anything about it because her debt to income ratio, as we talked about earlier, is so high with all those car loans, and she doesn't have any of them. Her car's paid off. And so I highly recommend don't co-sign on anything. Cars are the number one thing we see on that, but it's true. If they pay late, you will not know about it and it impacts your credit score. So that's why I tell people don't co-sign. If you're going to co-sign, maybe your spouse that you're living in the same house of, maybe, but even if that sometimes. I'm not big on closing out credit accounts. Leave them open. Just let them sit out there. Just keep an eye on them in case you get a statement that says you have a balance or anything such as that. But closing out an account can negatively impact the score. And of course, if you have fraud, report it. Make sure you make something happen about it, because otherwise it'll just take off. If you want to do, there's companies out there I know like LifeLock, they advertise all the time, or different credit reporting or different credit monitoring services that you can have. May not be a bad idea. Just make sure you know what you're getting, what you're paying for on that end of it. So real quick here, because we'll jump through quite a bit, but some of the home financing options out there, are your typical government loans, FHA, VA, conventional loans. If you live in an area, sometimes like our Colorado or, on the coast, California, especially where high cost area and the loan's going to be over basically 550, you may have to look at a jumbo. Always options for down payment assistance, interest rates and mortgage insurance are huge discussions when you get into this aspect of it. Biggest challenges we see really that I see in my world is, the down payment, of course, income is always a big thing, but, credit score is a huge thing. So this is just a short list of what we see quite a bit out there that creates issues or can create issues on the loan process. That's why talking to somebody early is definitely the best idea. So normally, I get the question a lot, what do I need to get started? Well, just really, we kind of go off the rules of, I joke around, it's a rule of 2 years W-2s, 2 years tax returns, last 30 days or last 2 pay stubs, depending on how you're paid, and then last 2 months of bank statements. That's what we're trying to establish, is that you have a good pay history on your credit report, you make money, right? That money's coming in, you have a good work history, or just at least you've been working the last couple of years. If you've changed jobs in the last 2 years, completely fine. That is not a deal killer whatsoever. Some of the union guys I work with have 9, 10, 11 jobs in 1 year. Now my assistant and processor hate that because that's a lot of chasing down documents, but there may be a good reason why you've had multiple jobs. And if that's the case, that's not a big deal. But don't just say, oh, I just moved jobs, last month or whatever, so I have to wait. Not necessarily. Reach out, let's talk about it, let's see on that end of it. And then, a lot of times it is good to divulge if you have assets out there, stock, whether it be 401k, IRAs. Not that we need that money, but sometimes it's good for what we call reserves, or I call it window money. That way the underwriter can see you have money set aside, that if it all goes, horrible for you, there's still some money there. Because it's all about risk is what we look about that end of it. So I'm not going to go through all of this. This is something you can kind of look at in the future, but different options as far as when you look at conventional FHA, USDA, and VA. For real quick, conventional is just your standard, Fannie Mae, Freddie Mac. That's what a lot of people work with, and it's same with FHA. That's Federal Housing Administration, so that's through Department of HUD. They are, their options are sometimes, it says, first-time home buyer, but sometimes it can be for lower down payments or lower credit scores. USDA is rural development. So if you're going to live outside an area, typically of about 10,000 in population, that's a great loan option. It's one of my favorite ones to work with. Fairway actually does a ton of those. And then VA, of course, if you've served in the military and you have your VA benefits, then that is a wonderful option as well. And if you don't know if you have those benefits, once again, you can always check your certificate of eligibility with the VA to see if that's there. If you don't know how to do that, once again, you'll have my contact information, or reach out to your local VA office or a lender. They can pull that stuff for you too. The loan process here, Brian, I was looking at this and we got a little out of order here. So I don't know, it must have been when I sent it or whatever else, but the most important thing is to, before you even start looking at houses and want to make an offer, go get pre-qualified. Whether that's with your, like I said, with your bank, your credit union, with Fairway, whoever, go get pre-qualified. Because too many times I have people saying, hey, I want to go buy this house, but they haven't taken any of the steps to get pre-qualified, which just drives me nuts sometimes, because they want to know right now, or sometimes on a Saturday afternoon, and I don't have anything, right? So that becomes very difficult to try to make that happen for them. So you can always look at the steps, it's kind of a fun thing there. The quick do's and don'ts. So always keep documentation, right? Always keep things on hand. If you've moved a large amount of money from one place to the other, keep that supporting documentation, because once again, we can probably use it as long as it's not from your freezer or from under your mattress. We can normally use the money, and you'll be amazed. There's a lot of people that don't trust the banking system, which do I understand it? Not necessarily, but yeah, everybody has their own thing on that. But I've got clients many times that tell me they have $5,000, $10,000 in cash. Well, you got to get it in the bank. You got to get it. We have to get it seasoned, because we don't know as the lender or the underwriter where that money came from. So do always keep your documentation. If you're going to get a gift, or you're going to get any money that comes into that bank account, especially if it's thousands of dollars, make sure you coordinate with your loan officer. Make sure they know where that money came from. Because I had a client before I started working with them, just had cash advances into their, they'd take a cash advance from the credit card. Well, cash advance is an unsecured loan. We can't use unsecured loans for FHA. So now we've added another layer into difficulty of getting the loan approved. So we're having to kind of backtrack and work through it and see how we can best make that happen. But be aware that a new credit report may be pulled prior to closing. So we do something we call it a soft pull. So 10 days prior to closing, we do the soft pull. And what we're looking for, has any new debts been taken out? Have you not made a payment maybe on that end of it? Is all of a sudden you've maxed out your credit cards? All that can be an indication. The biggest things I see on that is, I've had somebody miss a payment before, which can be a horrible thing if they just didn't make a credit card payment, or if they took out a new line of credit. We have to know about it because we have to make sure that counts against you. Don't, close any, open or close any bank accounts or transfer money without talking to your loan officer. Don't put money in your account without at least notifying your loan officer that, hey, mom gave me $500. Is it okay if I put it in my bank account? Normally it's not a big deal, but it's always good to have that communication with your loan officer. Please don't change jobs in the middle of the loan process. I've had that happen where somebody said, oh, I just took a new job and I'm starting next week. And it's like, we're closing next week. So, that can always add a hiccup in there. Normally there's ways we can work around it, but it's always, I joke around, it's always easy if you tell me first, then I can fix it, right? I can't fix it if you don't tell me about it. And don't go buy furniture or appliances. I always joke around, since Brian and I are in the Kansas City area, I have clients call me so many times on a Sunday to say, hey, I'm at Nebraska Furniture Mart. They're running this great sale right now. Can I go ahead and buy this? I said, well, not unless you don't want to buy the house. So I normally joke around is furniture is always on sale. I don't know when they're not running a furniture sale, frankly. So don't go buy stuff on a credit card or open a new line of credit without discussing your loan officer first. So I know I've only got a couple minutes here, so I kind of want to switch gears a little bit here. And let me click through here.
You're good on time, Lee. You're pretty good on time.
Okay. And so just a little bit self-plug on Fairway. Like I said, we're in all 50 states. So if you want, and we're not cubicle. We don't, work as some companies are 100% online. I'm in an office here in Lee Summit, Missouri. Every one of our loan officers are in the local communities we serve and work at. So, I'm licensed in Colorado, Missouri, Kansas, and Illinois, kind of along that I-70 stuff there. I have the ability to be licensed in multiple other states, but our biggest thing is we're here to serve you, to make sure, you're doing the best thing for you on that end of it. We already kind of went through one of those. Oh, I guess kind of got a little bit of repeat there. So what I want to take the last couple of minutes about, as Brian kind of said to start with, is, for those of you that are nearing retirement or getting near that age, or think you want to do that 15 opposed to a 30, a lot of those questions, we come into, and especially as people get near retirement, we start talking about, what does mortgage look like in retirement, and how can a reverse mortgage impact a retirement strategy, whether it be positive or whatnot. And so a gentleman out there that is one of the top leaders in just retirement income planning, Dr. Wade Pfau, you can Google it. He's got plenty of articles and research out there. If you use a reverse mortgage strategically, it can actually improve the amount of money you can have at the end of retirement. And so real quick, couple things, because everybody has misconceptions, and that, I teach courses on this to realtors, so I could go much longer, but the basics of a reverse mortgage is you need to be 62 and older. One person has to be 62 unless you're in the state of Texas, then both of you have to be 62 and older. It is an FHA style loan, so it's guaranteed by the federal government and backed by the federal government. You have to live in the house at least 6 months a year. It needs to be your primary residence, and it generally won't affect your Social Security, Medicare benefits. We've never really seen it affect it. It's just, we always have to say generally for compliance reasons. But the biggest misconception I get from people is they don't keep their home anymore. Well, you get to keep the title to your home. Also, it is much easier to qualify for a reverse mortgage than it's a traditional mortgage. And the money you pull from that can be, is tax-free essentially, in this, that when you pull money from a reverse mortgage line of credit, you're not paying taxes on it. And the only thing you're responsible for when you have a reverse mortgage is taxes, insurance, HOA dues, and you just have to live in the property as your primary residence. Going on here, it does not require repayment until you leave the home. So there's no monthly payment due. You can make a payment. Payments are 100% optional. Most of my clients don't, but you can choose to make a payment if you'd like, and you get to decide when you sell the home. You can sell it, you could sell it at any point. You can have your heirs sell it. Doesn't really matter, because either you or however your estate plan dictates is what happens with the house. And you never owe more than the home's value. So it's basically what we call a non-recourse loan, in the sense to where you do not, for some reason, if you buy in an area or you live in an area that just tanks in value, you're not responsible for that negative, for that negative difference. And then lastly, you can use it to purchase a home with only about 30 to 70% down.